Islamabad, the government has given an understanding to the International Monetary Fund (IMF) to move to a single value-added tax (VAT) regime in the country as part of an overall medium-term macroeconomic framework envisaging 1.25 trillion rupees incremental federal and provincial revenues. This would mean an additional revenue effort matching about 2.6% of GDP, gross domestic product, over a period of 3 years. Federal taxes are committed to be increased by 2.3%, about 1 rupee and 8 paise, during the 3-year reform process under the IMF program, starting with 1.1% of GDP during the fiscal year 2019-20. This will be followed by 0.9% of GDP additional revenue generation in FY21 and 0.3% in FY22. Provincial taxes are committed to be raised by 0.1% of GDP every year to achieve 1.6% tax to GDP ratio during FY22 from the current financial year's ratio of 1.3%. Agriculture income and a movable property tax is to be strengthened under 3-year fund program. Broadly, the tax measures expected to deliver the targets include drastic reduction in tax expenditures by removing exemptions and excessive tax credits from incomes tax, sales tax and federal excise duty law, and moving to a single sales tax (VAT) regime by doing away with special procedures and reduced rate taxation, according to official papers seen by Dawn. Officials said these medium-term fiscal projections were based on annualized yield of key measures under the IMF program. For example, the two sides have broadly agreed to increase the overall federal revenue by 1.1% of GDP in the first year 2020 of the fund program. Out of this, a major chunk of 0.4%, more than 175 billion rupees, of GDP will accrue with the shift to a single VAT regime, and 0.3%, 130 billion rupees, through removal of exemptions and rationalization of tax credits. The remaining 0.4%, 175 billion rupees, is expected through strengthening of FBR, Federal Board of Revenue, formations, cleansing of databases, integration, data mining, efficient enforcement, process re-engineering, taxpayer facilitation, education, etc. That would mean about 43.5 billion rupees, 0.1% from each of the four heads above. The next year's FY21 additional revenues of 0.9% of GDP are targeted through further removal of exemptions and rationalization of tax credits and single VAT regime, 0.2% of GDP or 100 billion rupees each, followed by 0.1%, 50 billion rupees, from integration of goods and services tax, FBR strengthening, use of technology, facilitation, etc. Based on these details, the medium-term framework envisaged revenue effort of 1.1% in FY20, 0.9% in FY21 and 0.3% in FY20 that would take FBR's tax to GDP ratio to around 14% of GDP. Other policy and reform initiatives will include a reduction in the number of withholding taxes which are negatively affecting the use of banking sector or have an insignificant contribution towards revenue, besides freezing corporate tax rates at 30% or 29% and increasing the expanse of federal excise duty. This will also need the strengthening of FBR field formations through investment in IT, physical infrastructure and training by increasing investment from the current 0.68% of revenue collection to at least 1.25% in 3 years' time. In some countries, investment in revenue machinery and infrastructure goes as high as 6 to 7% of the total revenue collection, an FBR official explains. Government has conceded to the IMF that the present arrangement of 4 provincial and 1 federal authorities looking at goods and services tax has increased the cost of doing business in an exponential manner, and large businesses have been complaining about the compliance cost. In 3 years' time, we will move to a single tax collection agency with single return and single auditing authority to cut down on compliance costs, the government has told the IMF. This will be balanced through a revision of business processes, administrative structures and efficient dispute resolution mechanism with proactive settlement of disputes through the Alternative Dispute Resolution (ADR) system. These efforts will be coupled with taxpayers' education and facilitation by developing Android apps for filing of returns and payment of taxes. Cleansing of utilities database and data of immovable property ownership will done to help the FBI identify underreporting and non-reporting of incomes and sales through use of data mining. The federal government and the IMF generally agreed that the provincial government's role in resources mobilization was central, considering that the constitutional authority to collect sales tax on services and agriculture income tax was with the provincial governments. The provincial tax collection for FY18 was 402 billion rupees, which was around 1.2% of GDP. This includes taxation on the services sector of 224 billion rupees, 0.6% of GDP, and income tax on agriculture of 1.6 billion rupees, which is very negligible in relation to GDP. As such, with efforts, the provinces would increase taxation on these two sectors. The third area which provides great potential for provincial tax is urban immovable property tax, which remains largely untapped. The province's projected tax collection for FY19 at 523 billion rupees, 1.3% of GDP, which is 0.1% higher than that of FY18. The medium-term macroeconomic framework suggests an increase in provincial taxation by 0.1% of GDP each year. The provincial tax-to-GDP ratio, which is projected at 1.3% for FY19, will reach 1.6% of GDP in FY22. The Fiscal Coordination Committee, already notified, will be assigned to monitor the progress. Published in Dawn, April 20, 2019. Let's block ads. Why?